Tesla enters potential market crash danger zone. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. We also want to thank our Patreon supporters. If you were a Patreon supporter, you'd have gotten an email from us first quarter of the day, as well as some warnings about what might happen today in our pre-market note that goes to all of our viewers. So it might be in your best interest to become a Patreon supporter, especially because of how rapidly things can move with Tesla. So the focus of my talk today, and the one reason I wanted to do a brief one, is that Tesla's stock price fell by $43 today. Now, that drop is, I guess, 6% of the value of the stock. After market, we were down another 6 points. And so the question is kind of what's going on here. There are a lot of folks with different opinions about how and why this is happening. So one of the things I wanted to review is that there's a whole bunch of different ways you can try to categorize the narrative of what's happening, but I think there are some fundamental points that one might be aware of in this circumstance. In particular, we have a circumstance where there are some things that the Fed has no ability to do anything about. An example in this case would be, well, if oil prices and all the other commodities are up at high levels, especially think of lumber, etc., you now have an interesting circumstance because all of a sudden the behavior of the Fed, etc., is dictated to it by the inflation being seen all around. And so the big jump up on Friday suggested, hey, everything's fine relative to overheating on the employment front. But I think that whole situation may not be what it seems, because there are a lot of people who are currently getting stimulus checks that will end. And so that the real employment rate might have been higher had it not been for the money people have in their hands. So no, they're not going to work and overheating the economy. But my general point is that there's a situation going on where there are these different elements happening that are sort of bits of the cake, and it bakes into a larger entity. So perhaps since we sort of talked about the unemployment checks not being a huge problem, let's look at lumber. A lot of people have decided they want to own homes and no longer want to be in high density living situations because of its unpredictability and how that might affect if another COVID type disaster occurs. So what we wanted to then suggest or introduce is just this idea that, well, wait a second, the problem we're seeing is that there are sort of competitors for dollars. So if you think about it, what the job of the Fed has been was to lower interest rates to a point where you had these very low rates, and that gave little or no yield to seniors and other people that live off of the yield. Well, when you did that, all of a sudden their only choice was to go to the stock market, and on a monthly basis, when more money was coming in, that was still the case. So basically, there are certain high growth stocks like Tesla that were getting really high PEs that even now they're still deserved PEs. But the problem that comes up is, wait, you have a very high stock price, you have a high PE, and the two of them actually go together well. But so in theory, Tesla should be a $900 stock based on how the PE ratio should work relative to its growth rate. Now, in the case of Tesla, Roku, Microsoft, Facebook, all these different companies have, I want to call it validated PEs. Their PE ratio, which is the amount of earnings times the growth rate, is equal to a number. And most of these companies whose stocks are being hurt are, in a classical sense, meeting. Now, could their growth rate drop and then all of a sudden the PEs that they've been given are no longer validated? That's a question that's out there. The other thing that's lurking, though, is, well, what if you can get yield from commodities? or from other sort of fixed entities that you know, hey, there are X number of houses that'll be sold. There's X amount of lumber that'll be bought. Hey, Home Depot, maybe Lowe's, the manufacturers or sellers of wood. There are some places where you can get a really good yield with little or no risk. And so people are starting to say, let's roll out there. And so I believe that this is playing heavily into what we're seeing currently. Another variable that I'm seeing that I think is interesting to watch is what I want to call it the run for the hills model of investing / trading. So right now, the Wall Street, etc., is being ruled more and more by computers. And one of the techniques or strategies that's being used is to say, hey, if the coast looks at all hazy, let's sell everything we own and then, wait a day, maybe two, and we can come back in and grab things that have gotten too cheap, while our firm and others have been doing this strategy of sell everything. So we've seen numerous times how this cycle has gone back and forth. And so what I'm wanting to cover today is just that, is the fact that there's some new variables that are playing into what's happening with Tesla stock. And the challenge that's going on right now is those new variables can represent smaller percentages of stocks. 10 or 15% of the holders are in this mode. But when you have most of the holders holding for the long term, you can run into some difficulties with the subset of people who do trade shares and their behavior shifting the entire value of everything for everyone. One of my mentors at KKR informed me, he said one day, he's like, think about this. Only 10% of homes sell each year. Those 10% of homes that sell determine the value of the remaining homes that have not been sold. So I believe that we're sort of in that zone right now when it comes to stock, Tesla, etc., is that the 10 whatever percentage that does move around, as those exchange hands and we go into these panic selling modes, could result in a lot of money lost in a very short period of time. So I've been impressed by the number of people I've spoken with who are Tesla fans and that have made a lot of money owning the shares long term. I really, really encourage you to consider either hedging with some puts, selling, lightening your position a bit, or selling out just like the bots are, and then buying back in. Another suggestion is just the whole idea of what's called a stop loss. Maybe pick a price point, $10 or $15, $20 below where we are now, and list it in as a stop loss point so that if the stock does dip down 20, 30, 40, 50 points, as it prepares to drop another 50 to 100 points, you're out, and then you can get back in at a lower price and not have lost all of that cash in the process. So I bring all this up to you because I really think that we're in a interesting zone right now. Everything should be positive, but it's very clear from, I could name 15 great companies, that the market really doesn't want to deal with high PE ratio stocks right now. And if anything, there's a intense get away from those stocks because we've got better options to go to give consistent, predictable returns. So what this then means is that, hey, we're in a tough zone right now for the folks at Tesla and some of these other companies. Is it going to remain the case that is? No, it's not. What will happen is that folks will come back, and that's when the longer term investors tend to do well. It's just that in the short term, because of the run for the hills phenomenon, you could actually lose a lot of value before the time rolls around that the value investors start returning to purchase these stocks at steep discounts. So I kind of wanted to just do a brief show today, kind of focused on the fact that I hope I'm wrong, where everything's going to be great tomorrow and the stocks are going to be up. But I really think we're in a very dangerous period where the value of certain stocks could fall dramatically in a very short period of time. And you'll notice how, yes, Tesla's stock price was down, the NASDAQ was down, but the Dow is actually up. So it's a reflection of one comment that I've often heard is a concept called flight to quality. People are saying, we'll just go to quality companies handing out good yields, and we don't have to deal with the risks that the economy will negatively influence how things go for successful companies like Tesla. And then we'll get back to them later, but right now, safety is probably a good idea because a lot of losses can be incurred in a short period of time. So, please remember to like and subscribe. Also wanted to encourage you to share with us constructive comments that you might have. And we also want to share our health tips for today. Please remember something in the realm of forest bathing is a great health tip to consider. Number one. Number two, also encourage you to not go to bed within 4 hours of eating, minimum 2, to allow the food to digest before you fall asleep. That eliminates the chance of acid reflux and other issues. Also wanted to encourage you to consider going for 2 weeks, going to bed and waking up at the same time, even on weekends, to allow your body to get into what's called a circadian rhythm, which will help your whole sleep pattern process. I also wanted to recommend that you consider no more than once a week for fried foods. Our kidney doctor indicated to us that this is a very serious issue relative to type 2 diabetes, etc. I think we'll leave our health tips at that. We have a list that's below here that you'll find. We've got information there for our Patreon. And if you want to support the channel in that manner, we also do have a few more SpaceX shares. If you'd like to consider that, hit us up at Teslafaninsight on Facebook. And I think that covers the show for today. This is Greg for Teslafaninsight. Tschüss. Au revoir, French, Lehithro, Hebrew, Hoda, Hafez, Farsi, Strasvice, Russian, Ni hao ma, Chinese, Konbanwa, Japanese, good day, our friends from Australia. And I kind of wanted to close with the fact that if you don't want to sell your shares for a good reason, which is that you'd have a big tax bite if it's not inside your 401k, we also offer trade consulting to help you learn how to trade options a bit and therefore have a way to somewhat protect your portfolio versus having to sell out. Anyway, again, thank you once again for joining us. We look forward to your comments and